Take a moment and slow down for a second. What we are watching right now is not simply another weekend pause in the market. It is the quiet moment when the architecture of the next financial week begins to take shape. As of today, spot gold is hovering above the $5,200 level, trading around $5,217, $5,231 per ounce. Silver is fluctuating close to $88, $89 per ounce, reflecting persistent safe haven demand across global markets. At the same time, the energy market is sending its own message. Brent crude is near $87.57 and WTI around $83. The market is cooling slightly after the dramatic spike triggered by tensions in the Middle East and disruption fears surrounding the Strait of Hormuz. Institutions like the International Energy Agency are discussing the possibility of the largest strategic oil release ever. That tells you governments are no longer simply observing price movements. They are actively trying to shape them. Meanwhile, voices from the White House and analysts like Jim Rickards continue debating whether energy shocks and supply disruptions will become the next engine of inflation. Because once energy moves, everything moves with it: transportation, food, manufacturing, and ultimately the cost of living for ordinary people. If you step back and look carefully, you begin to realize this is not just about metals or oil anymore. It is about how power, policy, and markets quietly reorganize the world before most people even notice the shift. Which brings us to the deeper layer unfolding beneath the silver market itself. Now let's slow down and look carefully at what the silver market itself is quietly revealing. Sometimes the most important signals in finance are not the loud headlines. They are the small gaps that keep widening day after day. As of the latest trading sessions, Western spot silver has been fluctuating around $88, $89 per ounce. In Shanghai's physical market, the same metal is being priced much closer to the mid-90 range. This leaves a premium hovering near 14 to 15% between Eastern physical demand and Western paper pricing. That difference tells a deeper story. Real metal is moving east while the paper benchmark in the West still assumes equilibrium. At the same time, inventory reports from COMEX continue showing steady withdrawals of deliverable silver. When physical supply tightens quietly while futures markets still dominate short-term price discovery, the structure of the market begins to shift beneath the surface. This shift is occurring while Western retail investors are still largely absent. In other words, this is not yet a speculative frenzy. It is a structural pressure building inside the system. Historically, when physical demand begins separating from paper pricing like this, the market eventually reaches a moment where that gap can no longer remain invisible. Which leads us to the deeper forces now shaping global supply, energy markets, and geopolitical risk at the same time. Now let's add another layer to this picture. What is happening inside the silver market is not only about price, it is about who is actually buying the metal. Over the past several sessions, delivery data from COMEX vault reports has continued to show steady withdrawals of physical silver by institutional buyers. Large commercial desks and professional commodity traders are quietly taking delivery of real metal. The broader public is still watching from the sidelines. At the same time, something even more interesting is happening in the investment vehicles that normally reflect Western retail sentiment. The Sprott Physical Silver Trust, PSLV, has recently traded around a 5 to 6% discount to its net asset value. This is a sharp contrast to the 17% average premium it carried during the 2011 silver rally. That single data point tells you a lot about the psychology of the market. Retail investors in North America and Europe have not yet returned to silver in any meaningful way. For analysts who study market structure, this contrast matters more than the daily price chart. When institutional demand builds first while retail participation remains absent, the move is often driven by strategic accumulation rather than short-term hype. If Western investors eventually return when headlines begin highlighting the price surge, the shift from discount to premium alone could amplify the upside dramatically. Which raises a much larger question about why these institutions may be positioning now. Geopolitical tensions and global energy markets are beginning to reshape the broader economic landscape. Now let's widen the frame for a moment. The silver market is not moving in isolation. Behind the price chart sits a geopolitical landscape that has become more unstable over the past several days. Energy markets are reacting first. Brent crude is trading close to $87 and $88 per barrel, while WTI sits around $83. These levels remain elevated as tensions around the Strait of Hormuz continue to dominate global risk calculations. Nearly one-fifth of the world's oil supply passes through a single corridor. Even the perception of disruption can ripple through every financial market on the planet. Recent military developments in the Middle East have intensified that sensitivity. Reports of Iranian activity near shipping routes, Israeli air operations, and the positioning of additional U.S. naval assets in the region are increasing attention from policymakers and energy institutions such as the International Energy Agency. These are operational realities that traders, central banks, and governments must now price into the system. When energy begins to move under geopolitical pressure, the consequences rarely stop at oil itself. Higher energy costs translate into transportation, agriculture, manufacturing, and the cost of living for households around the world. The events unfolding across the Gulf are part of the structural forces reshaping the financial environment in which metals, currencies, and global capital will move next. Now let's talk about the layer that quietly sits beneath all of this. Once energy begins to move, the consequences rarely remain inside the energy market itself. Over the past several sessions, crude benchmarks have reacted to the instability around the Strait of Hormuz. Brent is trading near $87, $88 per barrel, while WTI is hovering around $83. Those numbers may not yet look like crisis levels. Shipping routes that carry roughly 20% of global oil flows face disruption risks. The system does not wait for confirmation. It prices in probability. At the same time, energy institutions and policymakers are responding. The International Energy Agency has discussed the possibility of releasing strategic oil reserves. Governments are attempting to stabilize the market before volatility spreads further. Analysts such as Jim Rickards have argued that energy-driven inflation is fundamentally different from demand inflation. Central banks like the Federal Reserve cannot simply raise interest rates to produce more oil or reopen a shipping corridor. When supply shocks collide with monetary policy like this, the result becomes a chain reaction moving through energy, currencies, and real assets. That is where the next chapter of this story begins to unfold. Now let's step back and look at who may be carrying the heaviest weight if this energy shock continues. Markets rarely distribute pain evenly. Right now, Europe appears to be the most exposed part of the global system. Before the Ukraine war, much of Europe's industrial base depended on cheap Russian pipeline gas. That era ended quickly. The continent pivoted toward imported liquefied natural gas supplied by partners such as the United States and Qatar. Disruptions across the Middle East energy corridor and uncertainty surrounding LNG supply have pushed European gas prices higher. This reminds policymakers in Brussels how fragile the region's energy architecture remains. Energy costs determine whether factories remain open and whether production slows. When energy begins shaping industrial survival like this, it reshapes the balance of economic power across the global system. This brings us to the next signal emerging from central banks and the gold market. Now let's turn our attention to another signal that often moves more quietly than oil or equities. Historically, it speaks just as loudly about the direction of the global system. Central bank gold accumulation is that signal. According to the most recent disclosures from the People's Bank of China, PBOC, China has increased its official gold reserves for 16 consecutive months. The latest update added roughly 30,000 troy ounces. Total holdings are now around 74.2 million ounces. That level of consistency is not tactical trading. It is strategic positioning. The World Gold Council noted that global central bank purchases slowed earlier in the year compared with the previous 12-month average. China did not slow. It continued accumulating metal even as spot gold trades above the $5,200 range. Price alone is not the primary concern. When sovereign institutions buy through rising prices, they are adjusting reserves for a different financial environment. Other governments are navigating different pressures. Policymakers in Poland have discussed the possibility of using reserve assets to support defense spending. Geopolitics is increasingly intersecting with balance sheet decisions. When central banks begin shifting reserves this consistently, it rarely reflects only the present moment. It reflects how they believe the architecture of the future monetary system may evolve. This brings us back to the deeper structural changes unfolding in the silver market. Now let's come back to the silver market itself. Beneath the geopolitical noise, there is a structural shift taking place. Very few mainstream outlets are discussing it. Data from the Commitment of Traders report published by the U.S. Commodity Futures Trading Commission, CFTC, shows that large commercial traders have been steadily reducing their short positions over the past several months. These traders historically dominated the short side of silver. For decades, silver ranked as the commodity with the highest days to cover concentrated short exposure. Recently, that position has shifted. Platinum now occupies the top spot. That change may appear technical. Its implications are significant. When the institutions that once provided the largest source of selling pressure begin stepping back, the structural ceiling that restrained price discovery starts weakening. Paper markets still control short-term price movements. The COMEX leverage ratio is roughly 7 paper ounces for every registered physical ounce. This can generate sharp corrections when algorithms or macro headlines shift sentiment. Over longer cycles, markets eventually reconcile paper claims with physical reality. If that reconciliation begins in an environment of geopolitical stress, tightening energy supplies, and central banks accumulating hard assets, the silver market may be approaching a moment when its quiet structural tension becomes visible to the entire world.